How much money can you actually make from real estate in the US every month? Is it the passive income dream everyone talks about? Or is there a catch? Let's break down the real numbers. So, you see these headlines, right? I made $10,000 a month from my first property. And you wonder, is that even possible? The short answer is yes, but the full answer is a lot more interesting. Let's dive deep into what determines your monthly real estate earnings, from rental income and cash flow to all those sneaky expenses. First things first. Let's talk about the big number, gross rental income. This is the total rent you collect from your tenants before any deductions. Let's say you buy a single-family home and rent it out for $2,000 a month. That's your gross rental income. If you have a duplex and each side rents for $1,500, your gross income is $3,000. Simple enough, right? This number varies wildly across the country. A property in San Francisco might rent for $5,000 a month, while a similar one in Cleveland might only get $1,200. So, location is everything. Your research starts here. What are the average rents in the market you're interested in? Use sites like Zillow, Rentameter, or even local Facebook groups to get a solid idea of what your property could realistically command. Now, here's where most beginners get tripped up. That $2,000 a month isn't what you put in your pocket. We have to subtract their expenses, and there are more than you think. The biggest one for most investors is the mortgage payment. This is often referred to as PITI, principal, interest, taxes, and insurance. Let's use an example. Say you bought a house for $300,000. You put 20% down, which is $60,000, and you finance the remaining $240,000 at a 7% interest rate on a 30-year mortgage. Your principal and interest payment would be about $1,600 a month. But wait, there's more. Property taxes. These vary massively by state and even by county. In New Jersey, you might pay $6,000 a year or more on that house, which is $500 a month. In a state like Alabama, it might only be $1,000 a year, which is less than $100 a month. This difference is huge. Then comes homeowners insurance, which you absolutely need. This could be anywhere from $100 to $300 a month, depending on the property's location, age, and risk factors like floods or hurricanes. So, let's add it up. $1,600 for the mortgage, let's say an average of $300 for taxes, and another $150 for insurance. That's $2,050 a month. If your rent is only $2,000, you're already losing $50 a month on paper. And we haven't even gotten to the real asterisk expenses yet. This is why the famous 1% rule can be a bit misleading. The rule suggests that a property's monthly rent should be at least 1% of its purchase price. So, a $300,000 house should rent for at least $3,000 a month. In our example, if you were getting $3,000 in rent, you'd have almost $1,000 left after pity. That looks much better, doesn't it? But hold on. Next up are the operating expenses. The big three are vacancy, repairs, and property management. Let's start with vacancy. Your property will not be rented 100% of the time. Tenants move out, and it might take you a month or two to find a new, qualified one. A good rule of thumb is to budget for 5 to 10% of your gross rent for vacancy. On a $2,000 rent, that's $100 to $200 a month you should set aside. Then we have repairs and maintenance. The toilet will break. The dishwasher will leak. The roof will eventually need to be replaced. For this, many investors use the 50% rule as a very rough guideline, which says that half your rental income will go to expenses, not including the mortgage. A more precise way is to budget between 5 to 15% of your rent for repairs. Let's call it 10%. So another $200 a month for our example property. This also includes bigger, long-term costs called capital expenditures, or CAP, things like a new roof, a new HVAC system, or new flooring. These don't happen every month, but when they do, they cost thousands. You need to be saving for them consistently. And finally, property management. Are you going to manage the property yourself or hire a professional? If you self-manage, you save money, but you're the one getting the 2 a.m. phone call about a burst pipe. If you hire a manager, they'll handle everything from finding tenants to coordinating repairs, but they typically charge 8 to 12% of the monthly rent. For a $2,000 rent, that's another $160 to $240 a month. Let's recalculate with these operating expenses. Let's assume you're getting $3,000 a month in rent this time. Your pithy was $2,050. Now, let's add vacancy at 5%, that's $150, repairs at 10%. That's $300, and property management at 10%, another $300. So, your total monthly expenses are $2,050 plus $150 plus $300 plus $300, which equals $2,800. Your gross rent was $3,000. Your total expenses are $2,800. Your net cash flow is $200 per month. $200. That's a far cry from the thousands people brag about, right? This is the reality for many investors, especially in the beginning. $200 a month or $2,400 a year from a $60,000 down payment is a 4% cash-on-cash return. Not amazing, but it's positive. So where does the real wealth come from? It's not just about the monthly cash flow. There are 4 other major ways you make money in real estate. 1. Your tenants are paying down your mortgage. In our example, part of that $1,600 mortgage payment is going towards the principal. In the first year, it might only be a couple $100 a month, but it grows over time. You are building equity without lifting a finger. 2. Appreciation. Historically, real estate values tend to go up over the long term. This isn't guaranteed, especially in the short term. But over decades, it's a powerful wealth-building tool. That $300,000 house could be worth $400,000 in 10 years. 3. Tax benefits. This is a huge one. The government allows you to depreciate the value of your property over 27.5 years. This is a phantom expense that can reduce your taxable income, sometimes even making your positive cash flow tax-free. You can also deduct your mortgage interest, property taxes, and all those operating expenses Talk to a CPA who specializes in real estate because the tax advantages are significant. And 4. Leverage. You only put down $60,000 to control a $300,000 asset. If that asset appreciates by just 3% in a year, that's a $9,000 gain on your $60,000 investment. That's a 15% return from appreciation alone on top of your cash flow. So, how do people make $5,000 or $10,000 a month? They scale up. Nobody gets rich off one property's cash flow. They buy another and another. Imagine you had 10 properties, each cash flowing $200 a month. Now you're at $2,000 a month. What if you found properties that cash flowed $400 a month? Now you're at $4,000. What if you bought larger multifamily buildings, like a 20-unit apartment complex? If each unit cash flows just $150, that's $3,000 a month from a single property. The key is to buy right. You make your money when you buy, not when you sell. You need to analyze deals conservatively, accounting for all potential expenses. Never fall in love with a property. Fall in love with the numbers. So, to answer the question, how much does U.S. real estate actually make per month? For a beginner with one property, it might be a few $100s. But that's just the start. That small cash flow is the seed. The real wealth comes from mortgage paydown, appreciation, tax benefits, and your ability to scale your portfolio over time. It's not a get-rich-quick scheme. It's a get-rich-slowly but surely plan. What are your experiences with real estate cash flow? Are my numbers realistic for your market? Let me know in the comments below. And if you found this breakdown helpful, make sure to hit that like button and subscribe for more no-nonsense real estate content. Thanks for watching, and I'll see you in the next video.